Welcome to 𝗥𝗵𝗲 show. We are grateful to have you always with us. And today, my amazing co-host Ria is going to be leading the conversation. And I'm so excited that to having you with us, to come in and tune week in and week out to listen, learn, and grow, because this is where growth really happens. That, you show up and you not only are you showing up to your best good, but it's also to implement on the knowledge that we share with you. So, Ria, I'm going to pass the mic on to you. But before I bring Ria on, I want to introduce myself. My name is 𝗥𝗵𝗲. Welcome to the show for the new ones that are tuning in. And Ria, I'm going to pass.
My name is Ria, and
welcome to our show. Ria, I'm going to pass the mic to you.
With less risk. So previously, when I talked about the higher returns with less risk, I discussed specifically on OPM, other people's money. Today, we're going to talk about ROI, which stands for Return on Investment. So ROI, or Return on Investment, Robert says it's a confusing concept for many investors. For example, when we read financial publications, many mutual funds claim they have gone up to 10%. Now, Robert's question that we should also ask ourselves is, did any of that 10% return to investors? And how did they measure that 10%? Robert says some funds measure the 10% by the price of the shares in the fund that's going up. So for example, let's say 1 year ago, the price per share in the funds was $10. Now, today, it is $11. So they can claim that 10% return. In this case, the return was measured in capital gains. Now, Robert, as an investor for both capital gains and cash flow, and the only return that Robert would count is the cash flow. So if Robert invests that $10 each year, now that $10, he earns $1. $1 goes into his pocket from the cash flow. Therefore, that $1 is now a 10% return. So how did we get that? $10 times 10% will give you $1. So that's why if you're $10 from your own pocket, right, you invest and you earn $1, which goes into your pocket from the cash flow, that is equivalent to a 10% return. Now, Robert do not count the return on asset appreciation. Why is that? Because the asset appreciation is an estimate and does not become a reality unless Robert or unless you sell the asset. Now, the difference is one measure of the return of investment is on the price of the stock. So people who invest their money into Wall Street, one measure of the return of investment for them is the price of the stock. The other measure of the return of investment is the money in your pocket right away. So this is, for example, owning properties where you are a landlord, you're renting out your properties. You do have cash flow, and that puts money directly into your pocket. That is if you are positive cash flow. Now, Robert wants both 10% in asset appreciation. Appreciation takes time. It just doesn't happen immediately. And 10% cash in your pocket. Now, the other thing that I would contribute on the appreciation, it takes time. The other thing too is if you buy the property for cheap, right? For cheap, and you fix and flip it, then you at a higher price, then you get the appreciation right away. Now, cash flow, according to Robert, is the only return that can be tangibly measured while Robert holds the asset long term. Remember, cash flow is the only return that you can touch, that you can get tangibly measured while you hold the asset. Fourth, matching 401k contributions with your own money. In America, in USA, it is very common that if you work for an employer, there is a thing called 401k. It's a retirement account that the big employers offer to their employees. Now, Robert says that another confusing point is that financial planners claim that the companies match our retirement fund contribution. So there's a thing called, if you contribute $1 for your own retirement, your employer matches it to like 50 cents. Okay, 50 cents. That's what's called matching our retirement fund contribution. For every dollar you put into the retirement, your employer would match 50 cents. Now, if the match, according to Robert, is $1 for $1 up to a percentage, then the advisor may claim that the return of investment is 100%. However, Robert has a different opinion on this. This is not how Robert sees it. This is not how he sees it. Robert's way of looking at matching contribution is that the company is putting his money, your money, my money, when I work for an employer, in with more of Robert's money, with more of my money, with more of your money. In other words, according to Robert, the contribution that the company gives, right? They would hold it at first. They take it out from your paycheck. They would hold it. They take it out immediately from your paycheck. And then the company then contributes it. So when the company withhold it from your paycheck and then contributes it to your 401k, Robert said that this is still your money. This is Robert's money. This is my money and your money. So he thinks that what Robert is saying, that the money that you think that the company is matching here, that the company is matching is from the employer. He said, no, that is actually not the case. This is the employer withhold this from your paycheck and then contributes it to your retirement account, to your 401k. So it is actually your money that was just withheld by the company. This is what he is saying. The contribution the company withholds and the company that contributes is still your money, Robert's money. It is the money the company should have paid him anyway. It is a part of Robert's total compensation. And this is an expense to the company. What Robert is saying here is that this employer matching of 50 cents, this, if you're an employer, this is a tax deduct from your company. Okay, this is a tax deduct from your company. This is an expense from your company. So the company, if they have employees, it brings down their income because this is an expense. It brings down their gross income. So remember that the retirement account, it is your money. It is my money. It is Robert's money. And this matching can be offset but it can be offset by the company to their net operating income, therefore bringing their net operating income higher. It can offset their gross operating income. Why? Because it is an expense. And I never knew that until I read the book and I understand, oh, I didn't realize that the matching is from my own money. I thought that it was actually from the employer's money. But no, according to Robert, the company withholds it from your paycheck and then put it back into your retirement account. So that is something new that I learned from today. And hopefully you learned that too. So when Robert talks about leverage return, he talks about someone else's money, not Robert's money. So leverage return is this. So when you want to buy a property, right? When you want to buy a property, let's say you want to rent it, right? For rent. And now you become a landlord. Borrow money. So this is what is called leverage money, right? This is what we call OPM, or other people's money. Those are the terms, other people's money. So what that means, leverage money or other people's money, other people could be the bank, okay? Could be the sharks, could be your friends, could be anybody, as long as it's not your money, it's other people. So leverage money, other people's money, for example, the bank, right? And you want to buy this property. This property is 100,000. Now you go to the bank and say, hey, Mr. Banker, I want to buy this 100,000 worth of property. What I will do, I will put up my own money of 20,000. Usually it's 20%. And the bank's money is $80,000. So then that's how you're able to buy the $100,000 property. That is what it's called, leverage money or other people's money. So this is why Robert says, when Robert talks about leverage return, he talks about someone else's money and not your money, not Robert's money. And a 401k, which is something I learned, is that this is all part of my total compensation, right? That is all part of it. I thought it was actually the employer, but it is part of my total compensation. So those are the lessons I learned from today's topic, higher returns with less risk on ROI, or return of investment. So let me know in the comment section below, what is your one key takeaway from this topic? And stay tuned for more of Alka and Ria show.
Thank you, Ria. That was talk about the 401k. You know, in Canada is RRSP. So pretty much the same. So you know what? I was exactly the same as you. I thought that the employer matches that contribution.
Yes, that's actually what I thought of, that it was actually their money, right? The company's money. But Robert just made me realize, made me aware that it is part of your total compensation. They withhold the money from your paycheck right away, and then they start contributing, right? If you put $1 into your retirement, then they will match it 50%, which is common here in America. They will match it 50% or 50 cents on every $1. So, but I didn't realize that 50 cents was coming from my own money as part of my total compensation. So, and number 2 lesson is that's if I'm the boss, I'm the owner of the group, I can actually bring down, right, lower down my gross operating income, because that a retirement account is a tax deductible event. It's an expense it's an expense from the company, from the employer. So now their net operating income, remember, net operating income is gross operating income minus expense is the net operating income. So when you're an employer or you have a business and you employ people, then your gross operating income minus the expense, which in this case, the 401k is an expense. So that means it brings down your gross operating income that you have to pay. So you have you have you pay less taxes because that is an expense. So your net operating income is less. So when you have taxes, when you pay taxes as a business, you look at the net operating income that you pay taxes on.
Right. Okay. So the 401k or RSP is you are taxed on this.
No, you are not. So 401k is pre-tax, right? So you are not taxed on this unless, number one, unless you pull it out. If you pull it out before the retirement age, then not only are you taxed on it, but you're also gonna have to pay the penalty fee for early withdrawal. But if you return the money back within a certain period, then you're not gonna pay that penalty fee. But if you're not able to return it, then you would have to pay the penalty fee. But that money that you took out is now part of your income because you took it out. So that will be taxed according to your tax bracket. Now, I'm not a CPA, so that's a full disclosure. So you would have to talk to your accountant to know the exact amount, what your penalty is, how long, right? How long can you return the money once you take it out? How long? It could be 3 months before you get penalized. If you cannot return it in 3 months, then you're gonna pay the penalty fee. So talk to your CPA or certified public accountant for more information.
Exactly. Wow. That's great information. And so guys, implement on what Ria has just shared with you. As she said, what's the one takeaway that you are going to do from hearing the conversation today? So we have come to the end of another amazing show. Stay tuned for the next episode of Alka and Ria show. And you know what, as I always say, knowledge is power. Knowledge without the implementation is, it's just knowledge, but you're not making the best use. And how you make the best use is implementation of the knowledge that Ria and I share with you. So we hope that you've truly enjoyed the conversation. Stay tuned for more Alka and Ria show, and we look forward to seeing you back again.